Antonina, maybe we can start with you. You're involved with the academic side of things. You study this area at the Transition Pathway. We've heard a little bit about it already today, but I'm very pleased to have you here. So you do think about how transition finance can somehow either be applied to encourage action in this area, but equally maybe is being held back by risk of greenwashing or fears about it. Can you tell us a little bit about your academic work and what you see here?
Absolutely, yeah. So the Transition Pathway Initiative Centre, we're a research centre at the LSE, and we actually were born out of an ask from institutional investors, mainly asset owners based in the UK, who recognized climate change as a systemic risk. And also some had even set their own net zero targets, and they wanted to be able to understand which are the companies that we can invest in to meet that target, to make progress, to reduce systemic risk of climate change. So they contacted the LSE to build a partnership and essentially have an independent third-party assessment of corporate emission reduction targets, but also the climate governance practices that they have to evaluate the quality of their commitments.
So you're a watchdog in a way.
In a way, yes. And the reason that facilitates transition finance in particular is because the difference between green finance and transition finance is possibly worth distinguishing in this panel. So green finance is those assets that are purely green, clearly understood to be green, more or less controversial taxonomies to define that. But broadly, it's fairly clear, and it's usually at the asset level. When we talk about transition finance, we're broadening the scope to talk about the entity level. So we'll hear about transition plans that are going to be at the entity level and emission reduction targets that are going to be at the entity level. So that information that we provide on entity level alignment and credibility is where our data can feed into that process where investors will then make decisions where they're going to allocate capital, also how are they going to engage as shareholders, what are going to be the priorities that they should be asking companies to prioritize.
So what's one interesting insight or nugget from your analysis you can share with us? Because a lot of us may not have had the chance to look at your website or your reports. So give us an idea of sort of what's a interesting thing you've come up with.
Absolutely, yeah. So our latest State of Transition report that we published in September found that 30% of the roughly 400 companies that we assessed their emission reduction targets, and we use sector-specific benchmarks to evaluate the ambition of those targets. So roughly 30% of those 400 companies had a 2050 target that aligned with 1.5 degrees. So a third of companies. That's sizable. But when you look into the medium and short term, that number falls to closer to 18%. So that intermediate alignment is another key ingredient to this question about the credibility of transition finance. And coming back to your question earlier about greenwashing risk, that's the other barrier here to transition finance, is that investors do not want to be accused of greenwash. So they need to have a really clear confidence that the company is serious, that there's a true plan, that there's clear disclosure, that it's not just waffling.
Do you find that the gap between short-term and medium-term is reflective of lack of ambition, or is it, what's going on there actually?
It's likely to be a horizon kind of bias, something in the distant future. It's easier to make a commitment to that. But it depends on the sector. So there are some sectors where the benchmark is actually slightly more generous in the short term than the long term. So it's easier to align in the shorter term. So there are different factors there. But I think often it's about that horizon issue, unfortunately.
Yeah, that's a tough one. Kate, let's turn to you. At E3G, you look after finance and resilience issues. Can you tell me, companies tend to focus on the physical aspects of climate change and climate risk. Can we look broader than that? Some of the transition finance planning, do they look at more holistic or societal impacts, other kinds of risks that need to be taken account of going beyond the physical risks?
Yeah, sure. And I should say I was here for some of the earlier sessions and I saw some really interesting discussions that you chaired earlier today that were looking at the physical risk side. It's striking how much that's coming up in the course of today. So, as previewed, I was anticipating talking a little bit today about transition plans, which is something that we've done a lot of work on at E3G in a few different ways. And where did transition plans come from? They've become a very popular tool. Increasingly large numbers of companies are preparing transition plans as part of their business strategy and then disclosing them. They're doing that partly because they see, a potential regulatory imperative coming down the line, but also because increasingly there's a very clear business value in doing that. And where do transition plans come from? Partly it is from companies setting these long-term decarbonisation targets and then really kind of being challenged by the market to say, like, really? How are you actually going to achieve that? What is your credible plan for getting there? But also, transition planning is about actually managing those risks and those opportunities that are going to arise over that period, some of which are already manifesting, some of which we know will grow in the future. So transition planning for a firm really gives them opportunity to integrate both that decarbonisation side and that risk management side, including physical risk and adaptation, and also to explain what is the role of that firm in the economic transition. Like, what's the firm's strategy to actually be part of this economic change that we're going through. And because the plan sets all of that out, it actually can be a great tool for mobilising transition finance, something investors are increasingly looking at, something that's increasingly integrated into different types of financial instrument like loans and for example. So
I have a question for you. You advise companies on their transition plans, as you say, right? And you've seen now companies are up to their second or third generation of transition plans at this point, if I understand. I wonder how you deal with macro uncertainties, even metaphysical uncertainties, because I've just gone through the Shell Oil Company scenarios, right? Shell is renowned for its scenarios exercise. It's an independent unit from the strategy unit or the business unit, and they've just revised their existing scenarios to add a new scenario that looks at a case of accelerated AI adoption. Right? That's sort of the main thing. There's a few other variables in there, but that's really what it is. It's the what if AI really takes off kind of scenario. And what you find is quite dramatically different outcomes than in the conventional scenarios, which are sort of done in the wake of the Russian gas cut off to Europe and sort of an energy security gloom and doom scenario where climate becomes much less important. We all lived through this, so I don't need to describe it in detail, but you get the point that there are a couple of scenarios that are incumbent scenarios from a couple of years ago, and then they added this one. And in this context, again, it's speculative, but it's not an unreasonable speculation that AI might well proliferate and have a powerful impact, as perhaps the internet did in a couple of decades previously. And how do you do with some degree of granularity and precision transition planning when, again, just to give that as one reference point, they predict that we will see dramatic acceleration in climate technologies, that and including resilience technologies, that the world will be much better adapted, again, assuming, and much more efficient. Because, again, fundamentally, AI can be used as a tool for efficiency. Whether you care about the environment or not, you would do it because it has good payback, it's more efficient, but that spares resources, right? And therefore helps the energy transition get much more accelerated. How do you account for a factor, an X factor like that, that's not really so easily calculated or modeled?
Well, sure. So I'd take this back to transition planning being part of a business's overall strategy planning, and the same kind of rules apply. You need to know what are your assumptions. You probably would have wanted to go through some sort of scenario testing in advance of coming up with your plan. And this is where some of this would be covered. Of course, we heard from the Central Bank of France earlier about the climate scenarios that they've put out and are continually improving. But for business strategy, you're going to be looking at a range of scenarios, not only climate scenarios, although they should be included. When you're developing a plan, you need to state your assumptions, and also stating your dependencies is a very important part of a plan. Like, what would need to change from other actors for you to be able to fulfill this plan? And crucially, a plan's dynamic. If there's one thing we know about a plan, it's going to change. So just like all business strategies, a transition plan is going to need to be continually updated. Every few years, it's going to need to be revisited. So this makes it very different from some of the other kind of tools that we've seen in terms of, say, emissions reporting or other kinds of backward-looking disclosures. This is a forward-looking tool that sits alongside scenario analysis.
Okay, so keep at it. Don't. It's not one and done. You need to keep up.
Yeah, and make a start. Just
right.
Taking the first step is the first step. It doesn't have to be perfect on the first round.
Yeah. Great, thank you. Rhodri, you come at this from a financial and numbers perspective. You're head of research there at the CFA Institute. When you look at the question of how companies are allocating capital, again, decarbonization is the topic we're discussing. How do you see the question of risk, de-risking? Should companies that are thinking about net zero go whole hog and just invest in decarbonized? Or there is this, again, this phraseology of brown to green, sort of investing in transition assets, or, so what, from your point of view and what you see at CFA Institute, what do you advocate?
Yeah, I think, as you say, this transition from brown to green is an important story, and it's a communication challenge in a lot of ways. If you look at how investors are building sustainable investment strategies, typically they're oriented around building low carbon portfolios, allocating to companies that have low emissions profiles, or tilting towards companies that score relatively highly on emissions-based metrics. So if you're having a communication with your end investor, an asset owner, let's say, and you're thinking of including some sort of allocation towards supporting a transitional activity, investing in a high emitting sector, it's a difficult conversation sometimes to say how this is a fit within a broader sustainability objective. So that's one issue that I think we need to overcome with transition finance. And that's why some of the points that Kate and Antonina have made are so important here, that having credible and economically feasible transition plans facilitates that storytelling and that narrative, and communicating to those end investors how this fits within a broader sustainability strategy. Very, very important. I think one of the other challenges that we haven't touched on yet in the panel is really around regulation and disclosure frameworks. So this has been a huge area of focus, particularly in the European Union, but also in other jurisdictions, with the development of taxonomies and associated disclosure regulations. Again, how transition finance fits within that broader, let's say, effort to create sustainable taxonomies is not always an easy fit, because again, if you're building a sustainable investment strategy, you want to make sure that your investments can be deemed sustainable within let's say, a green taxonomy. But again, you're investing in that brown to green transition, and that doesn't always fit neatly within those disclosure and taxonomy frameworks. So there's a number of challenges there that need to be addressed, but simplifying and communicating the importance of this is key to that. And I think a starting point is having those credible transition plans.
And divestment poses a dilemma as well, right, when it comes to accounting and so on.
It does. Clearly that's an option. You could say from a real world perspective, divestment doesn't solve the issue of actually reducing the emissions and achieving those broader policy goals around net zero, because you're just shifting the ownership of those assets.
And sometimes to owners who are not as well governed or as likely to run them cleanly as you, right? We've seen this in multiple cases when they go into private hands or into non-publicly traded areas.
So I think where the ownership resides is a potential issue, and it does come back to, again, having disclosures and incentives, really, so that investors in public securities, public markets, have the right incentives and the compatibility of including transition finance within a broader sustainability portfolio.
Yeah, you wanted to jump in?
Yeah, just on the point about divestment, I agree with the risks that it can pose. It's not necessarily the best strategy, but there is some academic evidence that divestment can increase the cost of capital of pure play coal assets and companies. So there's levers that move all across the system, and there could be a case for it in certain cases, especially if the investor in question or a pension fund or a university endowment has wider political influence through that process. I would say there are other points to that, but not to disagree with how you frame it.
I think that's an interesting point. What comes with the divestment challenge again is who's going to then finance those assets and those activities, and does that create let's say more of a shock to the system? So do you want a smooth transition, which I think is what most policymakers would like to achieve, but it's a good policy discussion, is how quickly do you want to accelerate that transition?
Yeah, and I've followed this divestment question for quite a long time. Something like 20 years ago, there was a campaign for a Canadian company, Talisman Energy, to divest from North African oil venture. They did, under pressure, and the assets were purchased by one of the Chinese national oil companies, and they were run in a much less transparent way, and with widespread reports of human rights abuses and so on, and environmental degradation. We saw BP divest in Alaska, and the assets went to private owners. And by on-the-ground reports, the environmental performance has declined since BP was forced to divest. People who forced it to divest, who are standing outside this conference hall, no doubt feel very good about themselves. The planet doesn't feel any better, and the Alaskan tundra, which is now suffering from the environmental consequences of spillage, doesn't feel any better either. So sometimes there's false solutions that come along that need to be watched. Your point about marginally higher costs, maybe debt costs, or there's some leverage on some of these new owners, that's possible. But for me, the bigger point is if there is a demand for, in this case, we're talking fossil fuels, it could be other products that are considered dirty, somebody will get it to market. It's a question, and so simply shifting assets around doesn't get at the root cause. You need to really have means of dealing with the demand for it. And until then, these are all either palliatives or worse. They're in some ways greenwashing exercises or virtue signaling exercises. But that's my point of view. That's not the learned experts on the panel. I don't want to put words into their mouths. Let's get a question for them. If somebody in the audience wants to take advantage of the brain trust we have here, anybody have a good question for them? Have we exercised your brains too much today?
End of day.
Is anyone actually, just on the question of divestment, how many of you think that I'm wrong? I'm being too cynical about the idea of divestment. How many of you think we should, public companies like BP or others should divest assets under pressure from climate activists and so on? How many of you think divestment is a good idea and that should happen? It will actually help the environment. Okay, we have a couple of people sort of, wiggling and waving and wagging, but many people do not share that view, or that you don't want to speak up on it. Let me just ask this person here, since you're courageously putting your hand up a little bit, and we have a microphone here that'll come to you. No, just in the second row here. She had her hand up. Just to give a counterpoint to my very aggressively stated point of view.
Thank you for putting me on the spot.
Yeah.
Well, I believe the responsibility of private sector organizations is to signal to government that they're ready for change, and divesting can be part of that strategy. So maybe within a broader system, it might make sense to divest. I understand that shifting, ownership around might not be the most useful, thinking of short term, but there could be an argument for it, in my opinion.
So you see some signaling.
Signaling, I think, is the responsibility.
And I think
of
the lady behind still want to follow up on this
businesses.
point. Did you? Sure. We welcome your input.
Just to clarify, I'm not advocating for divestment, and we very explicitly do not make investment advice. But it was to point out there is evidence that it may.
There is some evidence of some financial.
That's all.
Yeah, I've seen some of that data. It's not persuasive, but I've seen the data. Yes.
I just wanted to talk, Carmen Nuzzo from the Transition Pathway Initiative Center. I work with Antonina. That divestment can have an effect if it's done en masse.
Keep the microphone close.
Yeah, sorry. The divestment can have an effect if it's done en masse with critical mass. And there is a lot to be said about maybe the net zero commitments that investors have. Many have signed up these commitments, but they're probably not walking the talk as they should, because it's also in the positive way, because when companies may have taken, in the case of BP, the right approach, they haven't been rewarded for having been ahead of the curve compared to the other peers. So it's not to dismiss the case of divestment, but you need to have critical mass to have an impact. Otherwise, there is no movement in the cost of capital.
Right. Yeah, fair point. Okay, I see that we're just out of time, so I'm going to draw the session to a close. Please give a round of applause to my lovely panel here for taking us through a complicated topic. Thank you very much. We appreciate your input.